If you're watching this, you're probably already familiar with QQQ, one of the most popular growth sector ETFs in the world. But here's a surprising truth. In 2025, there are at least 3 growth ETFs that are outperforming QQQ, and if you want to stay ahead of the curve, you need to know about them. This isn't about chasing hot picks or flipping stocks. It's about serious long-term growth and not falling behind. Today, we'll walk through exactly what these 3 ETFs are, why they're beating QQQ this year, what makes them different, and how you might consider positioning them in your portfolio. Let's begin with some context. QQQ tracks the NASDAQ 100, giving you exposure to many of the major tech and growth-oriented names. It's been a solid pick for years, but as markets evolve, some better diversified or lower-cost growth alternatives are grabbing a bigger edge. According to one recent article, another strong growth ETF also decidedly outperformed QQQ. So the real question, what drives the outperformance and how can you benefit? ETF number 1. Let's call this one Broad Growth Champion. This fund offers large-cap U.S. growth exposure with a wider basket of names than QQ, a slightly lower expense ratio, and a design built for long-term compounding rather than just momentum. For example, QQQ has around 100 holdings, heavily concentrated in large tech firms. But the Broad Growth Champion may hold 150 to 160 stocks, spread across sectors like tech, consumer discretionary, healthcare, and even some emerging growth names. That broader exposure helps when the largest mega-cap tech names take a breather. So far in 2025, that broader fund is showing stronger gains year-to-date than QQQ. And remember, when growth stocks rally, sometimes the ones just outside the top tier accelerate harder because they've more room to run. Why this works? First, the expense ratio. Even a few extra basis points matter when you're compounding for decades. Second, diversification within growth. By not being overly dependent on only the top 5 to 10 stocks, the fund has less single stock risk and better upside when market rotation happens away from the absolute largest names. Third, firm fundamentals. The fund's index targets companies with strong growth metrics, earnings growth, return on equity, future innovation, but doesn't overpay purely for hype. That gives it a cleaner, risk-adjusted profile. ETF number 2, let's call this one Sector Momentum Lever. This fund leans a bit more aggressively toward specific growth sectors, think AI, cloud infrastructure, genomics, mobility, and while its expense ratio may be slightly higher, its potential is greater. In 2025, some of those specific sectors are roaring ahead, and this fund is riding that wave. One trade publication noted that certain growth ETFs are outperforming QQQ across all time periods thanks to these targeted exposures. The idea isn't just tech in general, but disruptive tech with breakout catalysts. And in years like 2025, that can translate into meaningful outperformance. Why this works? Because when disruptive themes hit inflection points, you tend to see outsized returns. This ETF is effectively positioned to capture that. It gives you a higher beta exposure to growth. So yes, it's riskier, but for long-term investors with time on their side, the payoff can be significantly higher. The key is understanding that volatility will be higher, but if you're willing to stay invested and ride through pullbacks, the compound effect can outperform the broader growth fund and QQQ. ETF number 3. We'll call this one Global Growth Plus. Many growth funds are US-centric, especially QQQ, but this fund takes the same growth mindset and applies it globally. It picks companies outside of the US that are in high-growth industries, cloud in Asia, EV and battery tech in Europe, biotechs in Canada. Because it expands your opportunity set, you get access to growth stories the US may have already priced heavily. According to recent analysis of growth ETFs, this global tilt is a key differentiator. And this year, markets have rewarded diversification beyond the US, giving this ETF an edge. Why this works? First, firms outside the US often trade at lower valuations relative to their growth prospects. So you get more growth per dollar. Second, by incorporating global markets, you reduce the risk of concentrated U.S. tech downturns. Third, because you're effectively expanding your investable universe, you capture more potential winners, including companies that may become the next global Magnificent Seven. When U.S. markets face headwinds, the global angle acts as a buffer, and when global growth accelerates, you get leverage. Now let's dig into how and why these three ETFs are doing better than QQQ in 2025, and what that means if you're building or rebalancing a growth-tilted portfolio. Performance drivers. 1. Valuation risk in mega-cap tech. QQQ's largest holdings, e.g., Apple, Microsoft, Nvidia, etc., are already highly valued. In years when valuations compress, even strong growth stocks can stall. The broad growth champion avoids being overly concentrated in the top 10, so it's less vulnerable. 2. Rotation into new growth themes. The sector momentum lever ETF benefits when investors shift from incumbent tech names to newer disruptors. 2025 has seen that type of rotation, and when smaller or mid-cap growth names rally, that fund catches more of the upside. 3. Global Opportunity Set. The Global Growth Plus ETF has more room to outperform when international markets lead. In 2025, non-US growth themes, Asia Cloud, Europe EV, have strong tailwinds helping this fund pull ahead. 4. Lower fees/smarter diversification. Some of these alternative growth ETFs manage to deliver similar or better exposure than QQQ while charging less or spreading risk. Over long time periods, lower costs and smarter construction matter a lot. So how should you think about building with these? If you believe QQQ will continue dominating, great. But if you believe the next wave of growth is broader, global, or disruptive, then layering one or more of these alternative growth ETFs makes sense. Here is one possible portfolio framework: 70% QQQ, if you still want QQQ as your core growth anchor. 20% broad growth champion, for cost-efficient diversification of growth exposure. 10% sector momentum lever, for high beta exposure to disruptive themes. Alternatively, if you believe global growth will lead, you might use 50% QQQ, 30% global growth plus, 20% sector momentum lever. The key is aligning your allocation with your risk tolerance, time horizon, and belief about where growth comes from next. Key risks to remember. High growth ETFs are inherently more volatile than broad market or value funds. Expect sharper drawdowns. Disruptive themes can fall out of favor quickly. Timing needs patience and a long horizon. Global growth exposure introduces currency, political, and regulatory risk. Past outperformance is not a guarantee of future results. Always take the long view. Why QQ is struggling in 2025 compared to these ETFs? While QQQ remains a powerhouse and still one of the most popular growth ETFs in the world, 2025 has exposed several vulnerabilities in its structure. QQQ is top-heavy. Nearly 50% of the fund is concentrated in a handful of mega-cap stocks like Apple, Microsoft, Amazon, Nvidia, and Meta. Under normal conditions, this concentration propels QQ upward faster than almost every other ETF. But in 2025, this same concentration is working against it. Several of these giants underperformed due to margin compression, regulatory pressure, cooling AI spending, and shifting investor appetite toward mid-cap and small-cap innovation. Meanwhile, the ETFs highlighted in the video, SCHG, VUG, and IWP, benefit from broader diversification within the growth segment. Instead of relying on 5 or 6 giants, these ETFs spread weight across dozens of companies, benefiting from growing themes like cloud reinvestment, infrastructure digitization, industrial automation, biotech innovation, and clean energy hardware. In other words, while QQQ is tied to a handful of engines that slowed down, these ETFs draw power from dozens of smaller but faster-moving engines. Another major driver behind their outperformance in 2025 is the macroeconomic environment. With interest rates stabilizing after the aggressive cycle of 2022 to 2023, growth investing came back into favor. However, investors are more cautious now. They want growth, but not at sky-high valuations. That makes SCHG, VUG, and IWP more appealing because their P/E ratios are lower than QQQ's. Their earnings growth is more balanced. They are less exposed to regulatory risk. They include companies earlier in their growth curve. 2025 has shown a rotation away from mega-cap tech and into broader innovation, especially software as a service, industrial tech, fintech infrastructure, and next-gen healthcare platforms. These sectors are heavily represented in the outperforming ETFs. QQQ's sector composition has remained fairly consistent, heavy tech exposure with lighter allocations to biotech, industrials, and energy. On the other hand, SCHG, VUG, and IWP each have sectors that are thriving in 2025. SCHG is strong in software, financial technology, digital payments, and industrial automation. VUG sees tailwinds in cloud infrastructure, cybersecurity, medical devices, and AI-integrated manufacturing. IWP gains advantage in mid-cap areas like robotics, specialty semiconductors, biotech development platforms, and green infrastructure firms. These are the sectors benefiting from re-accelerating global investment and government incentives. This sector dynamic alone explains a major portion of their outperformance. In 2023 and 2024, investors flooded money into AI hype, especially the mega-cap leaders. But in 2025, the narrative has shifted. Large AI models are becoming more commoditized, margins are tightening, and competition is fierce. Investors now realize that the longer-term winners may not be the biggest companies, but rather the mid-cap enablers. Companies that build specialized chips, automation tools, software integration layers, robotics, and machine control systems. IWP, in particular, is full of exactly those mid-cap names, which is why it's leading the pack. SCHG and VUG also benefit because they include second-tier AI players, companies that aren't trying to dominate AI itself, but are integrating AI into their business models to improve productivity, reduce costs, and accelerate product cycles. This broader exposure to practical AI application has helped these ETFs outperform QQQ, which is dominated by companies already priced for perfection. Another big factor in 2025 is the valuation reset. After a volatile 2022 to 2023, many companies in SCHG, VUG, and IWP entered 2024 with very reasonable valuations, much lower than QQQ's top holdings. As earnings began accelerating again during 2024 and into 2025, these underpriced growth stocks saw strong price-to-earnings expansion. Meanwhile, mega-cap tech stocks in QQQ were already fully valued, meaning they had much less room to run. So even though QQQ companies are still high quality and profitable, the ETFs with smaller or moderately sized growth companies had more upside because they were early in their earnings growth cycle. In simple terms, the market discovered new winners. Another underappreciated factor is demographics. Global demand for healthcare, medical devices, cloud efficiency tools, and fintech solutions is booming due to an aging population and the need for more efficient systems in developing countries. VUG and SCHG include numerous companies at the intersection of healthcare and technology, fields that are seeing powerful demographic tailwinds. By contrast, QQQ leans heavily toward consumer hardware, broad digital advertising, and general-purpose cloud infrastructure, areas that are growing but not accelerating at the same pace as specialized health tech and automation. Why more long-term investors are increasing ETF diversification. Before 2024, many long-term investors placed enormous emphasis on QQQ as the core of their growth holdings. But 2025 showed that relying heavily on mega-cap tech can leave portfolios too concentrated. This has caused a shift in strategy. Investors are now using a three-layer growth approach. 1. Mega-cap tech, QQQ, stability and consistent innovation. 2. Large-cap broad growth, SCHG-VUG, higher growth potential with reasonable risk. 3. Mid-cap growth, IWP, where breakthrough innovation is happening. This layered structure provides exposure across the growth spectrum, reducing reliance on the performance of just a few companies. What does this mean for investors going forward? If 2025 has taught investors anything, it's that relying solely on QQQ, even though it's a phenomenal ETF, might not be enough to capture the next wave of technological and economic growth. The economy is diversifying, innovation is spreading beyond just a few companies, and the ETFs outperforming QQQ show exactly where the new growth engines are emerging. But the bigger takeaway is this: mega-cap dominance in innovation is no longer guaranteed. The next 10 years may be driven by a wider set of industries and companies, and ETFs like SCHG, VUG, and IWP position investors to benefit from that broader evolution. If you're looking for growth today, consider that QQQ is still strong, but it may no longer be the only or best option. The three ETFs we've discussed are already showing stronger performance in 2025 and may continue to lead if the growth regime remains robust. They offer diversification of growth exposure, access to new themes, and potentially higher upside for long-term investors. If you invest with a 10 to 15-year horizon, layering these funds could give you a meaningful edge. Thanks for watching. If you found this useful, give this video a like, hit subscribe for more deep dives into smart ETF strategies, and drop a comment below. Which growth ETF are you leaning toward in 2025? QQQQ? One of these three, or a mix? Let's talk about your pick and your reasoning. I'll see you in the next one.